Welcome, friends. Today we're going to get into the 5 biggest multifamily deal breakers. Okay, so if you don't know me, my name is Agostino Pintus. I'm with Bulletproof Cashflow, and I'll tell you a little bit about myself before I get into all this. So what I do is I do multifamily deals. All right, I primarily started in doing B and C type of assets, and then from there I ended up growing into development and net lease type of deals too. But you know, the bread and butter for me and the business is still doing multifamily deals, all right? I discovered after working in corporate for many, many years that really multifamily is where it's at. And I left that whole corporate thing behind, 6-figure job, working in corporate at the C level, doing all that fun stuff to go all in on real estate. So today what I like to do is help people get into the real estate game just the same way I did, all right? So this is one of those things that I'm doing today, is telling you about these 5 deal breakers. Okay, so here's the thing. Evaluating a deal, it varies from property to property. Okay, so like I said before, I've done a lot of C-class stuff, did a lot of B-class stuff. Okay, if you don't know what that is, very quickly, A, B, C, D. A is like the brand new stuff. B is, you know, nice. Maybe it was a previous A, maybe 10, 15 years prior. C is your workforce housing. This is primarily where people are focused on. There's a lot of C-class assets out there. And then D, of course, is, you know, in somewhat not so nice areas, not so nice neighborhoods, right? A lot of high crime, poverty, that type of thing, right? People make money in all these different types of assets. It requires a very different strategy and a very different approach for each one. Okay, so, and I've done the full gamut. I've done it all. Okay, so in all these cases, it all comes down to nailing down your underwriting. That's what it comes down to. Okay, this means gathering the expenses, gathering the income data, building a financial model, comparing the rents of the different areas and the different units in that same market, doing the in-person visits, getting a hold of all the bills, interviewing even the guy selling the unit. That makes a difference too, and I'm going to get into that, okay? All this takes time. It takes a great deal of effort to put into, to pour yourself into a deal when you take it down, okay? That is when you consider the whole process of a deal, the most leverage that you'll ever have is at the very, very beginning, when you're gathering all the information and you're going to try to determine if there's a deal here. That's ultimately what it is, okay? So you want to make sure you get enough information up front so you can put it under contract. Generally speaking, you might have 30 to 45 days of due diligence, 30, 45 days to close. There's days that used to be actually less than that. Usually you do a 30-day look, 30-day close. These days, because of some of the issues from 2020 there, many of these companies that would perform your due diligence, third-party due diligence, it seems to be taking longer, right? So generally speaking, we always do like a 45-45, not because we want to, but just because of what's happening. It's more realistic to what's going on. Regardless, the underwriting is still extremely important. It's extremely important. It's even so much important that the said underwriting is going to tell you how that deal fits into your overall business plan. Because believe it or not, you're doing more as a real estate entrepreneur than just buying a property. A property is a business. A property is a business. It is a business with a P&L. It's got income. It's got expenses. You're paying taxes the same way you would if you're buying a business or running a shoe store, running a clothing store, running a restaurant. Same thing. You're serving customers. These customers live there and they give you rent. It's a business, okay? So you have to consider all the different things that go into the deal. You have to consider the underwriting. You have to consider the due diligence. You have to consider the type of debt you're putting on the deal. All of it matters. All of it matters, okay? So for me though, what I found is that there's 5 potential deal breakers that usually come up whenever I'm looking at a deal, all right? And I say potential because it doesn't always mean I immediately rule it out, but you know, it causes me to really think about, what else am I gonna run into with this deal, right? That's what I'm looking for, right? That's what I'm looking at. So, and usually there's some clues, okay? So let's get into that, all right? So number 1, Mistakes in the offering memorandum, okay? It's also referred to as the OM, offering memorandum, the OM, okay? The OM, or the offering memorandum, is a document that you're gonna get from a broker that's representing the seller, and they might send it to you. You might find one off of LoopNet or, the broker's website or whatever. Listen, you have to keep in mind, this is marketing. It is a pamphlet. It is a pamphlet about the asset. Nothing wrong with that. We look at pamphlets all the time, don't we? When we go buy a car, we're looking at the pamphlet. When we go buy whatever type of expensive type of deal of some sort, maybe a piece of furniture for your home or whatever, there's usually a pamphlet that comes with it. Not abnormal, right? Same thing goes for these assets. The brokers spend a lot of time summarizing the deal in this marketing. The pictures you see look phenomenal, okay? The purpose of the OM is to support the seller's asking price. So they're gonna make it look as great as possible. They're gonna have photos without a single piece of garbage in any of the pictures. I challenge you, next time you look at an OM, try to find a speck of garbage anywhere in any of those photos. You'll find none, all right? And that's okay, right? The typesetting will be very nice. It's gonna be very impressive. The intent, again, is to sell the deal at the highest price possible and yield beefy commission for the broker. That's what they're trying to do. And again, don't be mad at the game. That's just how it is, and that's all right. The OM is supposed to make the property look good. That's just how it is, right? So here's what the OM typically includes. Aside from details about the asset, where it's located, all that fun stuff, you're also going to get the trailing 12. It's also known as a T12. You're going to get the rent roll. The rent roll is typically the unit numbers and the rents that come with it. You don't get much more than that usually. If you're going to actually get it under contract, if you sign a non-disclosure agreement and all that, you're going to get all the information. You're going to get the person's name that's living there, the unit number. You might even get delinquencies. You might get a bunch of other information, but you're not going to see all that in the OM. In the OM, you're just going to see the basic rents per unit. That's it. Okay. So you want to get the real data here. Okay. So the point of the OM is to really help it serve as a guide with that specific financial data. Okay. What you're going to find to a large extent is that there's a lot of fabricated numbers in this OM. Okay? It's usually called a pro forma, right? And this is what the broker puts together to outline the potential of this deal. What is the overall potential of the deal? They're not trying to pull the wool over your eyes. They're not trying to, finagle you or trying to screw you over or whatever. That's not the intent here, right? That's not the intent. However, you have to understand that's usually best case scenario, and you really have to underwrite accordingly to the numbers that are realistic. That's what it comes down to. Okay? Maybe you look at the OM, you look at the financial information. You want to have real numbers here. Okay, so I've personally looked at many deals, and when the rent roll in the OM was different from the actuals. Some of them were off by over $100 per unit. Now, $100 doesn't sound like a lot of money, but if you're looking at an 80 unit deal, then it's going to make a big difference. From when you're determining the NOI, the net operating income, it makes a big difference, right? It could make the difference between a bad deal and a good deal, right? So it could mean if you see stuff like that taking place after you start digging into first the OM and then getting the actual financials, which is usually what you get if you express interest in a deal, I'm not saying again that you immediately discount it, but you have to understand what's going on with those numbers. Okay, so another thing that I specifically look for though is if there's some sort of financials, when you do look at the financials and say they do include it with the OM, if everything ends in a zero, every single thing ends in a zero. Now, it's nonsense when you see every single thing, every single expense ends in a zero, right? That never happens. When was the last time you went to a restaurant and the bill was exactly $80 or $100, exactly, down to the penny, taxes and everything else included? Doesn't happen, does it? Same thing goes with your expenses at your home, right? When was the last time we got a gas bill? It was exactly $120, right? That's a key that something's up, right? So the thing is like I said, you really want to understand where those numbers are coming from, okay? You want to understand where it's coming from. So, I remember this other time where they didn't add up all the expenses to the property, and it ended up being a higher cap rate. Well, why? Well, because the expenses were they were just left out. So it improves the NOI, giving you a higher potential return. But again, if the number is wrong, it doesn't really matter, right? It doesn't matter. So this is one of those things that you want to understand all the numbers in the underwriting. You want to understand where it's coming from in the OM and you're in the real deal. Okay. It's not an immediate, throw it out. This is a crappy deal or whatever. You just don't make a decision just based on OM. You want to get the offering memorandum, see what type of guidance it has, and then request the actual financials, the real numbers. And they'll have it. They'll probably send you a link to what's called a deal vault or some sort of OneDrive or a Dropbox or something like that. You can download all the actual numbers, hopefully have them in Excel, because it makes it easier to maneuver the numbers, right? Many of these brokers are often talking about cap rate. They put the emphasis on cap rate. Cap rate, cap rate, cap rate. Oh, it's all about the cap rate. It's not about the cap rate. You never buy on cap rate, ever. Don't ever buy solely on cap rate. Cap rate or capitalization rate is used for very specific assets that don't have varying degrees of expenses. Our net lease business, for instance, doesn't have the expense side doesn't jump up and down on a regular basis, right? On multifamily, it can. And the reason why is because your income varies, right? Depending on when people pay, it's not always the same, right? And your expense may vary too, right? Because again, as landlords, as owners, we're covering this sorts of things. So I talk more about this on the YouTube channel. So if you are looking for more information about how to buy multifamily, I have over 700 videos. I've done over 400 interviews just on the Bulletproof Cashflow show alone. Go ahead, check it out, totally free. Grab it, listen to it. And while you're there, subscribe, throw me some love. I would have greatly appreciated it. And because it helps us out, helps us the channel, helps us produce more stuff like this for guys like you, all right? So do that because, again, I talk about stuff like this all over the YouTube channel. Check it out, all right? So number 2, the unrealistic pro forma. Now, I touched on this in the previous one, okay? The financial performance of the property is very, very, very important. That's why you're buying this, right? Like when you're, that's the reason why we're doing this, So if you're looking at a deal and you're looking at the T12 and you see that the income is you see that you want to try to find that the income is very, very stable, generally that's good, right? But it's not always the case. It's not always the case. So I'll give you an example. Like one time I was looking at this 150 unit deal. The financials showed the gross income for 5 years starting at $780,000, increasing about $12,000 annually. Okay, that seems maybe reasonable, sure. The pro forma showed a gross income coming in to be over $250,000 from the current year. So it showed a 100% occupancy, exactly 100% occupancy. Now, what did I say earlier if it ends in a 0, right? That doesn't happen, especially on a unit that big, okay? On a unit that large, 150 unit deal, it's almost impossible to keep it at 100% occupancy. Now, it might be 97, might be 98, sure. If the rents are low enough and people and you run the property spectacularly, if anything, it means you might have room to increase the rents, is what it means, right? But it's never going to be 100%. It may be 100% for a short amount of time, but people are moving in and out all the time. It happens on a deal that large, it does, okay? But one thing that really tipped me off was the expense ratio. The expense ratio was 39%. Now, even with the best run properties with little to no maintenance, run at a 40% expense ratio. What does that property look like? That's usually going to be like an A-class property. Like I just built an A-class property recently. The property itself, there's nothing to do. It's still under warranty by the contractor that built it. Okay, so there's nothing to do. The expense ratio is about 40% today, right now, and the entire thing's under warranty. So what does that tell you, right? How can a C-class asset with the older assets, say built in the 60s, have a 40% expense ratio? It can't. It doesn't. Okay, 50% is probably most reasonable, and depending on where the asset's located, if it's located, say, in a cold weather climate versus a warm weather climate, that will impact too what the expense ratio looks like. Okay, so you want to try to find well-run type of properties is what you're going after. Okay, if the expense ratio is way too low, it doesn't make sense. So again, it's not a immediately dump it. You want to get to the bottom of it to see if you really like the deal, you like the location, you think there might be some upside. Usually if there's a 39% expense ratio, your alarm should go off and say, something's up there, all right? So there's another deal where I found the expenses were super low for that area. And I touched on this a second ago. But specifically, it was the annual water and sewage bill for a 30-unit deal. It was super low. It was only like $5,000. It was very cheap. And it was sitting on 1.8 acres of land where it was all this grass, so much grass. Now, something doesn't seem right. Like, the grass is nice, lush, green grass. How's the grass going to get watered? You're watering all that grass. It's a lot of maintenance just for that alone, let alone supporting all the tenants that are in there. Depending on, I think back then, that one was not billing back the water, right? So it's got to be realistic. It's got to be realistic, right? And if there's unrealistic numbers in there, chances are it could be could be some finagling going on with the numbers. Okay, you want to understand where all the numbers are coming from, and the best way to overcome an unrealistic pro forma is to base your analysis on how you will run the property. So if you're leveraging partners like a property manager, ask them to prepare a pro forma based on the seller data that you actually have and the knowledge of the area. Ask them to do it. Do not disclose any other information like the OM or anything else like that. Give them the property, the size, the age, the location, all that fun stuff. I would purposely not share any other information other than, say, the rent roll and pretty much it. Because I want to see how close they were to showing me a real number. That's why I did it that way. I purposely didn't disclose all the information. I wanted to see what they come up with, right? And to determine, based on what the other assets they might be managing in that area, hopefully you find the property managers managing other assets in that market, you have a very good idea. Now, these days, at the time of this recording, at the time of this webinar here, insurance is climbing up tremendously. So making sure that insurance is the right number there. You want to understand what that looks like. Okay, insurance is going up crazy at this point right now, right? But the key is always due diligence. Get your hands on the actual bills. Get your hands on the actual the actual expenses that are happening at the property, and you underwrite accordingly. Don't forget the taxes. The taxes from many of these municipalities, many of these cities, they're going crazy with taxes right now. All right, so the inflation that we're experiencing right now is not just a federal thing. It goes down to the state and local levels too. So be aware of the taxes, okay? Also be aware of certain fees. Certain cities, they're charging all kinds of crazy fees like rental registration, lead paint inspections, all kinds of stuff, okay? Try to know and understand that stuff and include it in your underwriting. That way, when you underwrite the deal, you can determine what the right number is to pay based on the level of risk that you're taking on to acquire the asset and make it better, okay? Third thing, the area, if you're buying in a bad area. So this is one factor that tends to be an automatic deal breaker for me if it's in a not so good location. Like, I'm looking for a deal in a good market and a good location. I can always fix the deal. I cannot fix the market. That's ultimately what it is, okay? Now, if there's no demand for people to live in that area, because there's no jobs, there's no money, there's no activity, it's probably not the right deal for you, right? If you're not able to go in there and raise rents, or you need to worry about appliances getting stolen in the middle of the night, you probably shouldn't do it. Now, here's the thing. If your plan is to do Section 8 and subsidized housing and all that fun stuff, you just have to budget accordingly. Like if that is the business plan, fine. That's the business plan. You have to budget accordingly. You have to budget for the repairs, budget for the rent delinquencies, because what you're doing is you're building the padding for that risk that you're taking on. Okay, that's what you're doing. People have made tons of money doing that type of asset class. It's perfectly fine. I mean, some people, they do it, but it's definitely not for the faint of heart. I would personally not recommend someone take that on as a first deal. That's just me. All right, I wouldn't do it. But you know what? If you want to go ahead and do it, you go ahead and do it. All right. So the key though is making sure that you have enough capital to back you up. That's what it takes, right? And if your business plan is sound and you got the stomach for it, maybe you want to raise money from other investors that are also, they're buying into your plan. If that's the case, go to guidetocapital.com. They got a free ebook there. You can download the free ebook, grab it, and learn about raising money for deals. Okay, guidetocapital.com. Put your information in, send you the book, totally free, but it goes through everything you need to know to start raising capital, right? It's an introduction, right? So go ahead and download that, all right? Like I said, the key is to make sure that everyone involved on the investor side anyway is familiar with what you're trying to do, all right? The business plan. The business plan is extremely important, all right? So let's keep going here. Number 4, unethical property manager and owner with a bad reputation, all right? It's, let's say that the financial data in the OM, the offer memorandum was done properly, or maybe there's some mistakes in it and you were able to clear it up. Maybe the intern didn't know what they were doing or whatever, right? You decide to go ahead and get your hands on the financials and, finally everything looks okay, and looks fine. Let's say you do that, right? And the thing is though, if you discover that the seller is not exactly a good person or is prone to not being a nice person, they tend to lie and treat their tenants very, very poorly, it could be cause for concern. And now, you probably never heard this before, right? But here's the thing. As I said before, at the beginning, I've done this business for quite a while. I've seen some stuff, all right? Like I've seen cases where the owner would basically just, harass people. Like he's just not a good dude. Like when we were doing an inspection once, I was doing an inspection was with a friend. This owner was harassing a maintenance guy that just happened to be, it wasn't even his maintenance guy, it was someone else, called by an insurance company or something like that. He was harassing him for God knows what reason, like just being a bully to him, right? And I saw that. It's like, that's not really nice behavior to just an individual trying to do their job. That's a cause for concern. If this guy's treating people like this, he probably doesn't have a good moral compass. He's probably an unethical dude, right? Do you really want to do business with someone like that? I don't know. I wouldn't. Is that enough to kill a deal? I don't know. It might. But at least what it does is try to dig in a little deeper to try to find exactly what's going on at that property. That's what it's caused to do, right? Whenever you see stuff like that, it's a flag. It's a flag that you got to understand what's going on, okay? So, here's the thing. It's one of those things that you want to understand what's going on at the property, and there's always a clue, all right? Like I did once. I remember I held an event once. I did an event once, and we used to do them on a very regular basis. One of our attendees discovered that the property manager was forging rent rolls. He was forging leases, forging other important information related to the property. So the property manager also had said they had 91% occupancy when it was actually more like 80%. So this person caught the property manager in a lie is what they did, right? So how do you discover such things? Well, they got their hands on all the leases and they performed a lease audit. And as they're performing the lease audit, they went to go walk the property and they see, it's like, wait a second, this shows someone's here in unit 102, and you go to unit 102 and there's just one individual with an empty unit standing there. That's called heads on beds, my friend, heads on beds. All they're doing is forging a lease, and then after the asset is transferred, tenant bounces, okay? Tenant audit and a lease audit, extremely important when you're doing these deals. Extremely important. Another time, I remember, this goes back a while, there was a broker forwarded a 200 unit deal to me, and I just did a quick search on the internet just to see how the residents rated the property. Like, you know, you go to Yelp or one of these other Google type scenarios and see, like, do they rate it a 4 out of 5 stars or whatever. Again, it's not always a bad thing if you see it rated 3 out of 5 stars, because that just means that the tenants aren't happy, and you might be able to go in there, fix the place up, and try to get some customer satisfaction in there. That's okay too. You know, if that's the plan, that's great. That's what we do. Like, we go into a property, we make it better, and we take the property over, right? But while I was searching, I came across a video on YouTube where the landlord was being faced down by a news crew. And the news crew was accusing the landlord of not turning on the heat for the tenants. And it was in the middle of winter, and it was like there's a whole bunch of drama, and the landlord's all flipping out, and it was just terrible, terrible. It's like something about not paying a bill or not repairing the boilers. It was madness, right? But you know what though? I know that kind of stuff can be fixed with proper management, but it's one indication of a problem, right? That maybe I just don't want to see more of it. Maybe I just don't want to see more of that type of stuff, right? This might be the case of what's called a distressed asset deal. You can do those too, by the way. A distressed asset deal, again, it doesn't mean you don't do the deal, but it's better suited for groups that have big pockets, and they can go in and do a whole uplift on the whole asset. Because usually it's not just a boiler issue. Usually it's a bunch of other problems too, if it's something like that, all right? Now, what's the last one here? Number 5, issues found with the walkthrough. Now, let's say everything looks good on paper. Now you're gonna do a walkthrough, and you're gonna go look at the property, and you wanna make sure that you can, you got a good understanding of the asset before you lock it down and get it under contract, okay? There's plenty of deal breakers you could find just on a walkthrough alone. So this one time I went to go look at this deal, and I looked at the number of cars in the parking lot. And if it's, say, like a Wednesday morning and there's a lot of cars there, it could be an indication that there's high unemployment happening inside that building, meaning the tenants are not really employed. And that might be okay, but you have to understand why it's happening. Are they on Section 8? Are they on subsidies or something like that? What's going on there, right? If the property looks like it's run down, it could also be an indication of that there's a lot of deferred maintenance. Again, that's fine. You have to document that. Make sure you're aware of what's going on, what's going to get built into your plan to fix it, right? This is where really the rubber meets the road on the walkthrough. Okay, performing that visit will impact your repair budget. Okay, I remember one time I went to go look at this little 4-story building with a student, right? The student got all the information, looked kind of nice on paper. We went to go look at it, and the area wasn't bad. Not bad at all, actually. So it looked promising, actually. And we go through the front looks great. And then we went around the back, and we looked at the wall. I'd never seen anything like this. The building was like splitting right down the middle in two, right? From the very top all the way to the middle, about the middle and the second floor of this 4-story building. And I'm like, oh my God, clearly this building is not like stable, right? That's a very expensive problem that you would never have seen from the front of the building, right? And it wasn't priced for that either, by the way, right? This isn't a case where you just have to like put some cover on it and that's it. This is a major issue, right? And keep in mind, this building was an older building, right? It was probably built in the 1930s or something, right? So a lot of older buildings that have these sorts of problems depending on when they were built. The cost to fix that would have been tremendous And that killed the deal right there on the spot. Okay, so the walkthrough, determining after you do your lease audits, that type of thing all fits into this as well, right? When you're inspecting the units, you're not just inspecting the floors, the walls, the ceilings, the appliances, all that stuff. You're looking at that. You're looking at whether there's fuse boxes or breakers. What sort of breakers are there? Are they Zinsco breakers or Federal Pacific? Those two catch fire. You don't want that, right? You want to have the breaker, typically in the Midwest anyway, you see a lot of Square D, you see a lot of Siemens, stuff like that. You probably see them in other places too. That type of physical inspection is extremely important. It's going to determine what your underwriting is going to look like in terms of your plan to fix the asset up, okay? So anyway, that's the 5 multifamily deal breakers. Ultimately, there's risk in every single deal you do. There always is. But it's your job as a real estate entrepreneur to create your plan and find assets that fit into the plan. Okay? Not all these deals are going to be perfect. Every single time, something always comes up. Okay? You're going to run into a lot of deals when you're doing it. But your job is to determine if the deal makes sense and to find the upside on the deal. Okay? Sometimes it won't be on the surface either. You got to dig in a little bit here too. You're not trying to shoehorn the deal to make it work though. You're not doing that. But you're trying to find some sort of upside to take on that risk. And if you can't find it, move on. It's okay. You notice that every single deal that gets traded on LoopNet, or tries to get traded on LoopNet rather, doesn't always go, right? There's a reason for it. It's not priced accordingly. It's not priced with that level of risk in there, right? If you're looking to get into this business, it's important to get involved with the right community that knows how this business is done, right? So we have the Multifamily Advantage Mastermind. So if you go to themultifamilyadvantage.com, you go there, you can learn a little bit more about how the mastermind works. Aside from doing an online type of course, we also have a weekly mastermind for 50 weeks. We meet and we share information about deals, and you actually you learn how to underwrite a deal properly, and you can also share it with the group, and it's a very interactive type scenario. So you're not doing these deals alone. You're doing them with a whole community, with yours truly in there as well, right? So my job is to help you guys get into deals, all right? Anyway, if you're watching this video post-webinar and you like this video, go to YouTube, throw me some love, subscribe to Bulletproof Cashflow, the channel. I'd greatly appreciate it. It helps us out when you do, all right? If you have any questions, by the way, go ahead and leave it in the comments, all right? Our team's always checking through, and we'll get back to you honest, all right? We always do. But the multifamilyadvantage.com, go ahead and check that out too. I think that'll be a great help if you really, really want to get into doing these types of deals and doing it the right way. All right, guys? Have a great day, guys, and I will talk to you soon.